Good evening. We are looking at the corporate finance preparation of preparing for a test tomorrow. Okay, so we look at a number of topics in this pamphlet. We'll do a selection of topics that we need to look at. Okay, so in CF, first and foremost, the topics that we'll look at the time value of money. We'll also be able to look at the second one, which is bond valuation. We'll also be able to look at the stock valuation. Okay, so also we'll be able to look at stock valuation. We'll also be able to look at, in today's session, we'll be able to look at capital budgeting. So this is just about what we be able to cover. All right, so getting down to this one, we'll select questions randomly. All right. Okay, so we'll do a random selection of questions. So question 4 of this paper was on capital budgeting. So it says Epica PLC is considering marketing a new product with a 4-year life. Epica will need to install new equipment to manufacture the product. Epica has to choose between 2 machines, both of which would be suitable. Machine 1 costs 460,000 to purchase and install, and will have a residual life of 20,000 at the end of 4 years. Machine 2 costs 630,000 to purchase and install, and has a residual value of 30,000 at the end of 4 years. Then says machine 2 takes slightly longer to install and commission, but once in operation, it has slightly lower operating cost per unit and will eventually produce more output. The following projections have been prepared of the cash flows from product sales and operating costs for the 2 machines. So machine 1, we have what we have been given here. Machine 1, of course, the initial outlay for this machine was 460,000. Then machine 2, the initial outlay was 630,000. All right. So outlay simply means expenditure. So meaning the cost of capital is 12%. So I'll be explaining the techniques that we use in capital budgeting. All right. So the simply saying all capital investments have to achieve a payback period of 3 years or less. So now here using the net present value method and paying attention to the conditions set on the payback, do calculations to show which project should be accepted and advise management. All right, so we are using the NPV for this one, the net present value. All right, so this is what goes on. Okay, so now here, what we are simply saying is that we should do the workings for machine one. So these are the sales, and then we have the costs. All right. So what is going on here is that working for machine one, the net cash flows for the year, the initial investment was 460,000. Okay. And then the sales minus the costs. So sales minus the costs, we are getting these are net sales. So these are called net sales. Okay, so sales minus the cost of sales. All right. So what we're simply saying here is that these costs, the sales minus the costs. So we are getting the 11340, 1160. So sales minus the costs. We have the net sales of these ones here. And then the residual value for this machine is 20,000. So that's what we have. So NPV is calculated by, okay, so the NPV is a net present value. So we are trying to calculate the net present value from here. All right, so meaning that these sales, we are going to use them investment of 40,000. It's a negative. It is actually negative because this money is how much we are likely to lose. So we're likely to lose the 460,000. So we have the zero. This is when you're making an investment. So description, these are cash flows. Of course, these are net cash flows. So these are net cash flows. Okay, from here, because we are simply saying sales minus cost of sales. So yeah, these ones. So net cash flow year one was 180,000, year two 200,000, year three 160,000, year four we had actually 60,000, and the discount factor is given by 1 plus r to the power negative n. So 1 plus r to the power negative n. This is what we have. So we got at 12%. the amount here is 12%. All right. So this is what goes on. So you're going to multiply, get the present value. So we're multiplying by this, we're getting this one. Multiplying by that, you get this one. You're multiplying by this, get this one. Multiplying by that, get this one. You're multiplying by this to get that one. The residual value is what remains from this machine at the end of, okay, so residual value is what, so this is what we have, okay? So residual value of 20,000. This money is actually what you are going to remain with after you purchase this machine at 460,000. Its value after 4 years, we can sell it at 20,000. That's why we are including here. We cannot throw this machine. We can recover our 20,000 actually at the end of 4 years. All right, so this is about why we are putting it here as well, because this is the amount that we can recover. It is the amount which we can recover. All right. So this is according to what we have. So meaning you add this one, you add this one, you add this one, you add this one, you add this one. Then you subtract how much you invested in. Then you're going to have net present value of 24,890. All right. So this will be our net present value of this machine. Are people getting what I'm explaining?
Yes, boss, we are.
Yeah, because what is happening is here we are just trying to look at the solution for this given problem. Okay, so the present value that we are getting, the net present value that we are actually getting, we are sorting out here sales minus the costs. We are getting the net sales, and then you have the residual value. Then from here, we are summarizing now here. Zero at year zero, this is a, of course, when you're getting the net present value, NPV is equal to sum of present values, sum of present values of all cash inflows, then minus initial investment. So minus initial investment, okay, in a project. So minus the initial investment in the project. So this is how you get the NPV. All right, so that's why we are simply now saying the summation of present values of all these cash inflows then minus initial investment in the project. All right, so we are getting a NPV of 24,890 for machine 1. Then machine 2, workings for machine 2. Machine 2, we are also getting down to the net sales, which means sales minus the costs to get the net sales. So sales minus the costs, then we're getting the net sales. Okay, so here, year 0 is 30,000. This is how much we invested. In year 1, we're subtracting now the 700,000. Yes, please, clear the question there. Is there a question, please?
Good evening.
Yes.
Yes, I just wanted to find out one thing on the residual value. Is it residual value? You're saying you can say and you can sell it in year 4 at the end of year 4, right? So when we're doing the calculations in year 4, where we're getting the sales less the cost, in just in year 1, that in the first one, yeah. When we're doing the year 4, where we're saying the 820 minus the 760, because this is the cash inflow minus the cash outflow, yes? So if we say the 820 plus the 20, which is the residual value, minus 760, then we find the answer. Would that also still work?
When we say what? We say 8 what?
The inflow, the 820, which is the sales, yes? Minus 760, which is the outflow. And then we've got the residual value, which says you can utilize it in the end of the year 4. So if we add the 820 plus the 20 in year 4 minus the 760, and then we find the answer, would we still, is it still going to give us the same answer? Or would that be the same approach?
No, yes, definitely.
Okay.
Yes. Okay. What we are just trying to explain here is that you need to show the examiner that we have included it here as a residual value. Year 4, but of course you have to indicate that it is year 4 so that the examiner is able to see. All right.
Okay.
I'm sure. So our NPV is giving us 24,890. Okay, 24,890 is our NPV for this one. Now working for machine 2, year 0 is 630,000. Year 1 is 700 minus 610, which is giving us 90,000. 1,400,000 minus 1,100,000, which is a 300. 1,600,000 minus 1,240, which is a 360. So this is how we are getting down to this. And then the residual value of that one. So meaning our NPV for machine 2, the discount factor here we get is 1 plus R to the power negative n. 1 plus R to the power negative n. This is our discount factor. All right, so this is about what we have is 630,000. So much we're multiplying, you're getting those ones. You're multiplying, you're getting, by multiplying these ones to get the values at the far end. You're multiplying to get the values here. You're multiplying to get the value here. Multiply, we get the value here. we multiply, we get a value here. Then when you add all these ones here, okay, we are getting, so NPV, you add all these minus how much you invested in this machine, then you are definitely getting the NPV. So the NPV is 61.59. This is what we have. Okay. So the question is telling us that using the NPV method and paying attention to the conditions set on paper, do the calculations to show which product should be accepted and advise what? Management. Okay. So we have to accept the NPV for machine 1 is 24,890. That of machine 2 is 60. So invest in machine 2 with a higher net present value. All right, so you need to invest in it, machine 2 with higher net present value. I'm sure people have actually followed. All right. So
sorry, Collins.
yes.
My network was bad. Where are we getting the residue value from?
Well, the residue value is from the equation. From this question, we have the residue value getting down to the question.
All right.
So from here, the residue value is given for both machines. The first one was 20,000. The other one was actually 30,000.
Okay. Thank you.
Okay, I'm sure you've seen that also.
Yes, I have.
Okay, so we are including the residue value in this way, in the workings here. So this is what goes on.
Okay.
And we have found that NPV for machine 2 is higher than NPV for machine 1. So this is why we have gotten this NPV machine 2. Okay, is this one. So invest in machine 2 with higher net present value. And it based on the payback, they were saying that the all capital investments have to achieve a payback period of 3 years or less. Payback simply means time taken to recover the exact amount invested in a project. Okay, so payback, it looks at the time taken to recover the exact amount invested in the project. So time taken to recover exact amount invested in a project. In a project. So this is what the payback period entails. All right, so now what goes on here is that machine 1, let's check machine 1 payback. So payback will be let's see how long it will take for us to recover. Machine 1, we have invested how much? 460,000, but we have recovered 180 in year 1. Then 200 year 2. Then 160 year 3. So add those ones, we have a 540. Now we need to recover exact amount, nothing more, nothing less. So meaning that you only have to add the 180 plus the 200, which is the 380 for these years. So 3 years here, that is 380 here, meaning that so far we will know that we are going to have 2 years, then plus the remainder is what? It's 4. You can just simply say we say 460 minus a 380 here for these two. These two have gotten a 380. So 460. So 460 minus 380. Four 460 minus that is 80. So it's 80, a remainder of 80. And that 80 remainder, we'll get it from which year? We'll get it from year 3, from 160,000. So we'll get it from year 3, which is from 160,000. Okay, so it will be 80,000 that we can recover from where? The 160,000. All right, so meaning we are going to have 2.5 years for this one. So you sort out this one here in plus a 2. Then machine 2, payback. Okay, so we have machine 2. Our payback will be equal to. All right, so we need to make sure that we know machine 2. Okay, payback will be, we have recovered how much? 90,000 year 1. We need to recover the exact amount. In 300,000 year 2. 360,000. So meaning it would be 2 years for these two. So it means 90 plus 300, 390. And then we need to recover the exact amount of 630. So there will be a 240 that we can recover, remainder of 240 that we can recover from year 3. Okay, so first of all, we have 2 years, then plus the 240,000 that we can recover from year 3. So year 3 is a 360,000. So over the 360,000, so meaning our payback is actually going to give us what? 240 divided by 360 plus 2.60, so 2.67 years. All right, so meaning It's okay because the examiner is saying that we have all capital investments must achieve a payback period of what? Or 3 years or less. So all capital investments must have a payback period of 3 years or less. So this is why we have this kind of parameter. Okay, so this answers this question. Unless people are behind, unless some people are behind so far.
The 240, how did you find 240?
Okay. So we are looking for machine 2. We need to recover the exact amount we invested in this machine. We invested how much? 630,000, right? Are we together there?
Yes, we are. Yes, we are.
So we recovered how much in year 1? 90,000. Year 2, we recovered how much? 300,000. So for these 2 years, we have recovered how much? 390. So if we add the 360,000, it will exceed. Okay, it will exceed it with 750,000, but we need to recover exact amount. All right. So don't add the 360,000. So what you do, you say 90,000 plus the 300,000 is 390. So what is remaining for us to get the 630? So just say 630,000, then minus the 390. That's where the 240 is coming from. I don't know if I've gotten my point.
Yes, I have.
So this is where the 240 is coming from. So we simplify this one first. This side. As you simplify this side, then you add the 2 years here, which will give us a 2.67 years. This is what happened even to the first machine. I hope I've answered the question.
Yes, you have. Thank you.
Okay. So let us now look at the other parameters, the other questions. Okay. This one is on the bond valuation. Bond valuation. I'm sure the background notes, Mr. Collins, I think, has explained somehow on the theories of a bond. Okay, a bond is just a long-term debt instrument issued mainly by the government. So as we look at the bond valuation, we are just trying to say that under this valuation, so under this valuation here, we're simply saying value of bond is equal to interest on coupon then you will say present value interest factor of annuity given n number of years and interest rate. then plus market value on the present value interest factor. So our variable bond is actually equal to, if we are going to break down interest on coupon, then 1 minus 1 plus r to the power negative n over r. This is provided that this bond is trading annually. So market value, then 1 plus r to the power negative n. So this is the annual bond. Formulas are given. So this is for annual. Then semi-annual. So semi-annual, the variable bond is actually equal to interest on coupon, then divide by 2 on 1 minus 1 plus r divided by 2 to the power negative 2n over r divided by 2 plus market value 1 plus r divided by 2 the power negative 2n. So that is a semi-annual bond. Then of course, we are getting down to youth maturity. So from here, we are simply looking at this question here in a nutshell. A Zambian company has a bond outstanding that sells at 87% of this. So it's selling at 87% of the par value of 100,000. The bond has a coupon rate of 5.4%, paid annually, and matures in 21 years. What is the youth maturity of this bond? So it says, what is the youth maturity of this what? Of this bond. So variable bond is equal to, so it's selling at 87% to 87% of this. So this is the bond price. So this is a bond price, okay, or selling price. So meaning it's selling at a discount. Why is it at a discount? Because the par value is 100,000. So par value is 100,000. So par value is equal to 100,000. Okay. So it's a discount bond. So how we find we want us to find the youth maturity of the bond is calculated by youth maturity is equal to interest on coupon amount plus market value minus variable bond over n over 2 variable bond plus market value over 3. This is what goes on. So our youth maturity is equal to interest on coupon amount, which is given here. Interest on coupon amount is 5.4. Okay. So we are simply saying 5.4 by 100 multiplied by 100,000 plus market value minus variable bond over N. N is a number of years remaining until the bond matures. All right, so this is just about how we are sorting out this one. So here we can simplify this side. So it is 13,000 divided by 21. Okay, then plus, okay, then plus 5, 4. So it's giving us 6019. This is the numerator. Over the simplification of these ones, this is 2 times 87,000 plus 100,000. Then divide by 3. And 1333. So after sorting out this problem, we are getting a yield to maturity of 6.59. That is the yield to maturity.
Collins,
All together.
Mr. Collins. Just a quick one.
Yes.
So can you hear me?
Yes.
I was saying that, so if we were to apply the formula for calculating the value of the bond using the different approach, not the one where we just multiply it by the par value, we'll still get 87,000, right?
We still get what?
If we were to use the formula that you gave us earlier for calculating value of a bond, where we plug in, we still get 87,000, isn't it?
Yes. When they say, okay, now they're saying that they're simply saying that this bond is selling at 87% of par. So, but in calculating here, the yield to maturity was not given. So that's why this formula, it is selling it sells for 87% of the 100,000, right? So what is happening? This formula, the yield to maturity, this one represents yield to maturity, which was not given in the question. All right. Even here, this one is the yield to maturity, which was not given in the what? In the question. These are here. Okay. So the yield to maturity was not given. So that's why they actually told us that this bond was selling at 87% of 100,000. So just selling at 87% of 100,000. So this is where you just calculate the bond price this way. But if the yield to maturity was given in the question, find the bond price would have gone for this formula here. Would have used this formula to find the bond what? The bond price. Okay, if the yield to maturity was given. But for the sake of the way the question came, getting down the bond price, just 87% of that. I'm sure you haven't avoided the distinction between the two, not so.
Yes.
So the equation.
Following up, just a follow up on that statement, on the 87%. As long as it's below 100%, that means it's discounted, right?
Yes.
If it was 120, it would have been a premium.
Correct.
Yes. Okay.
Yes.
All right. Thank you.
All right, okay, you're welcome. So we move on to the other ones. All right, so this is what is going on. So what is going on here? We will simply say this one for Kawaisha Corporation as a premium bond making semi-annual payments. The bond pays a 9% coupon, so it's a premium to be trading above 1,000. Okay, and then as a then now the Modi this other company, the Modiglian company, okay, the Modiglian company has a discount bond, so that's the opposite between these two. Discount bond making semi-annual payments. This bond pays a 7% coupon as a yield to maturity of 9%. So the other one was making semi-annual payments. Even this one semi-annual payments. 13 years to maturity. If interest rates remain unchanged, what do you expect the price of these bonds to be 1 year from now? So it's just about solving. All right. So 1 year from now, okay. And what is the most important thing to know is that this one, okay, the Kawaisha has the 13 years remaining to maturity. In fact, 13 years remaining to maturity for Kawaisha. So meaning we come here and sort out this semi-annual 1 year from now. Okay. So meaning that how many years are remaining to maturity? It is 12 years. Okay, 1 year from now. So meaning the N will keep on changing. 1 year from now, we have N is 12. So the semi-annual bond, the formula to use is this one, the one down. We are dividing. So meaning that here we are going to simply consider what we have. The rate here is 9%. This is yield to maturity is what we use here. This is coupon interest multiplied by 1,000 standard because the bond price is always at 1,000. Okay, so the bond is issued in denomination of 1,000 kwacha. So okay, so that's why 1,000 kwacha is there. So we are multiplying 1 minus, then here yield to maturity is 7%, which is 7 divided by 100 divided by 2. Then plus the 1. So this is how we are getting this one. All right. Then this one we are dividing. So this is this rate here. This is yield to maturity is the rate divided by 2. So we are multiplying these. So this is it, the premium bond, because the value is actually greater than 1,000. Then the other one here, for the same 2 years from now, meaning that the other one says 2 years from now. the number of years are just changing. 2 years from now means that, in fact, the other one says 8 years, in 8 years' time. Okay, so in 8 years, time, okay, we are simply going for the semi-annual, which means it's this formula to use. All right, in 8 years' time. Okay, so the other one says the rates here, they are changing in 8 years' time. So you really need to know how to use that one. Well, in fact, the other one says in 3 years' time. The first one is from 1 year, 3 years' time. So which means the number of years remaining to maturity is what? This bond at how many years? 13 years. All right. So number of years remaining until the bond matures will be what? 10 years remaining until the bond matures. So our N would be 10. All right. So here our N would be 10. So meaning our N would be 10. And what happens there? Meaning that the 7% divided by 2, I can just show on this one, okay, where we simply use the bond price of this one. Coupon interest will be 0.09 multiplied by 1,000. Just an example. Now we calculated that. Then here it will be 1 minus 1 plus 0.07 divided by 2, the power negative 2 multiplied by 10 over 0.07 divided by 2. Then plus, all right, 1,000, 1 plus 0.07 divided by 2, the power negative 2 multiplied by 10. This is how you're getting the value of a bond. All right, so you're getting the value of a bond that way. Okay, so this is how this answer came in. We found this is also a premium. This is where this negative point came from. So the most important thing to do is for you to understand what is going on. Then the other one, in 8 years, meaning that how many years are remaining until the bond matures? It is 13 minus 8. Okay, so 13, when we say bond matures, simply means we would have fully paid for that bond. So the number of years until the bond matures would be equal to, all right, what we have is, so it's also a premium. So that's why this one came in. So this is also premium. Then the other one, in 12 years' time, meaning there's just 1 year remaining. 13 minus 12. So 1 year remaining, we would have finished paying this long-term debt. All right, so this is how we're getting this as a premium. So please take note what we have done with this Kawesh Corporation solution. is what is supposed to be done as we look at the other company, which is a multi-client company. I'm sure, I don't know if people are following. People following, because people are quiet now. Are you following?
Yes, we're following.
So what you do, the same way I've explained the Kawasha Corporation bond valuation is the same way we can actually sort out this other company, which is a multi-client company. Okay. So this is what goes on here. I don't know if you have understood this. All right.
Just a quick one. Just a quick one.
Yes.
On the bond pays a 9% coupon, right? And then in the formula you said we multiply by 1,000 against the coupon payment, yes?
Yeah, yes.
Because we in Zambia they pay at 1,000, right? Pay 1,000. Then you divide that by 2. So if they gave us the coupon paid is 50,000 semi-annually, would have put 50,000 there. There would be no need for us to do a calculation. Yeah.
The coupon interest is always a percentage. So if you had put us the coupon amount, if it was in monetary term, would have just put the figure here.
Okay.
You know what I mean? Eh? Would have actually,
Yes.
you would have actually just put the figure here. That's all.
Okay.
Yeah, but now since it was a rate that was given, so meaning that you're supposed to calculate it and put it here, and then you sort out the way it is. So it was in a monetary term, would have actually put the figure here, and then just like that. So this is what goes on here.
Okay.
Okay, I'm sure I've answered your question.
Yes.
Then,
Basically, you're saying as long as it's interest they've just given us, multiply that by 1,000 and divide by 2 if it's semi-annual.
yes. So this other side we use the youth maturity. Okay. So this is the youth maturity, the rate here. You want to say something? Okay, so this is what is going on. So in on time, I want you to try and see and sort out this other company. Kawasha is from doing, but this other company, the Modiglian company, it's just the same principle that we used on this one, the Kawasha Corporation. So if the number of years, look at the bond that was issued for some number of years, so you look at how many years are remaining until you fully pay for that bond. That is the time remaining until the bond matures. Okay, so 1 year from now, 12 years remaining. 3 years time, you subtract from there so that you see how many years are remaining until that bond matures. So, and I've given you the formula for how we calculate semi-annual here, so we can simplify this and get the value here. For as long as the premium should be bond value above 1,000. So this is a semi-annual bond formula for semi-annual, and of course we have this one. So now we can try the other one. Okay, this other side. So you can look at a different question altogether. So what was going on here? So what is going on here is that maturity date reduces. The value of the bond also reduces, as can be seen from the computation. You can see what's happening. 1 year from now, we have 1160. And as we look at the other one, 1142. So the bond price is reducing. Of course, the benefit was the premium. In 8 days' time, it was 1083. In 2 years' time, it was 1018. So what is going on here is that as the maturity date reduces, the value of bond also reduces, as can be seen from the computation. So that is what is going on. And then the other bond type was a discount bond for the Modiglian company. It was a discount bond, meaning that the value of a bond was not supposed to be more than 1,000. It was supposed to be less than 1,000 for the discount bond. All right, so this is what is going on as we look at these two parameters. So please take note for a discount bond and the premium. So for this discount bond, the value of a bond, of course, the interest rate was given. All right, for this one, the interest rates were given. The coupon interest for this one was different. So coupon interest was 7%. And then it has also, they swapped the what? And then this other one was the 9%. Okay, so also 13 years. So meaning that here we are getting a discount bond of this amount. So the 9% applied here, but we divided by 2. Okay, because of using the formula for the semi-annual, which is this one. All right. So this is what is actually happening here. Okay, so we have that one as a discount bond. And then the other one, which is this one, are also a discount bond. Then the number of years remaining until maturity, the variable bond also is reducing. So just like that, that is what we have. All right. So we can earn only this question here, which
Sorry,
is
Mr. Collins.
oh, this is the yes.
Mr. Collins.
All right, you can actually you want to say something?
Yes, maybe just to draw you back a bit. So you said when we are computing for the other company, we apply the same principle like what we did, right?
Yes.
For finding the,
Yes.
or it's the same principle. Okay.
Some principle is the same, but just that they swapped the interest rate. This was coupon, this one, and then the other one was what yield to maturity was here. This one here, this is yield to maturity.
Mm-hmm.
So here we have coupon interest, and then this other one is yield to maturity.
Oh, so the coupon rates are the one that has just changed from the other one.
Yes. You get my point, right?
All right, thanks. Yeah, thank you.
So let's look at let's end on this question 6. This question 6 was on time value of money. Okay. Time value of money. And on time value of money, it means that you look at it to say money today is better than money tomorrow because of inflation. Chappie and Jane are saving for college education for their newborn son, Kasuva. The couple estimate that college expenses will run 30,000 per year when their son reaches college in 18 years. The annual interest rate over the next few decades will be 14%. How much money must they deposit the bank each year? Okay, so that their son will be completely supported through. So it's for the deposit each year, that marks an annuity. Annuity is a series of equal payment. So that's an annuity, because the annuity is a series of equal payment of the same amount. That is an annuity. So how much must they deposit in the bank each year so that their son will be completely supported through their 4 years of education? So it's 4 years. These people, they have agreed that when a child reaches 18 years, she will go to college for 4 years. But how much money are they supposed to be depositing from now for 18 years? Because the couple is made that college expenses will run 30,000 per year when their son reaches college in 18 years. So how much money must they deposit in the bank, okay, each year, so that they can support that child? Okay, so his parents will make the first payment. His parents will make the first of his 4 annual tuition payments on the 18th birthday. Okay, so they'll make that payment. They'll make the first of his 4 annual tuition payments on his 18th birthday. So they will make equal bank deposits on each of his first 17th birthdays, but not deposit on that year at 0. So meaning that I'm making a deposit at the end of the year, in short, for 18 years. So this is just to confuse. So what you do, you're making a deposit. It's simply saying you are making a deposit at the end of each year. Okay, so meaning that you're making a deposit on 31st, like an example, 31st December. So 31st December, you're making a deposit. So meaning that from what happens from Jan up to November. So meaning that it's more like we're making a deposit at random. So meaning 31st December 2023, an example. 1 year will be 31st December 2024. That's when 1 year will, that's why it will be more like 1 year has gone, because there's nothing that was happening from Jan to December 30. Okay, so meaning it's more like 1 year has gone, but in a nutshell, it was for 18 years. Okay, so this is why we use this is a present value interest factor annuity. So how much can they deposit now? Okay, so the present value interest factor of this annuity is equal to amount. This is the formula: 1 minus 1 plus negative n over r. So the 30,000, 1 minus 1.4 negative 18 over 0.14 is giving us 194,000, okay, 022.61. This is how much present value of that amount. That was this money is how much will support the child for 4 years. All right, through the education. That's what it means. All right. So the present value interest factor for this annuity will give us this, substituting this in the formula sheet here. We are getting 194 022.6139. Okay, so this is it, what is going on here. So please take note, this is what is going on. I'm sure people have gotten something. So this is an annuity. Okay, so for annuity, we have ordinary annuity and annuity due. So ordinary, this is where payments are made at the end of every period. Okay, so ordinary annuity. So the formulas are given. So for this one, we have the present value interest factor of annuity is actually equal to amount, then 1 minus 1 plus r to the power negative n over r. Then the other one, future value interest factor annuity is actually equal to amount, then 1 plus r to the power n minus 1 over r. So depending on what we have. So these are formulas for ordinary annuity. This is the present value interest factor annuity, the future value interest factor annuity. So this is what is going on. Okay. Then of course we have the annuity due. So annuity due, which means the beginning of period payment. Beginning of beginning of period payment. Okay, so meaning we are going to have the present value interest factor annuity is actually equal to amount, then 1 minus 1 plus r to the power negative n over r, then plus 1 plus r. It carries an extra interest. Then we have the future value interest factor annuity due. So even here it's due is equal to amount 1 plus r to the power n minus 1 over r multiplied by 1 plus r. So these are what we need to actually understand. All right. So this is what goes on. So we can look at the part B for now, as we are wrapping up. We can look at part B. Part B was on stock valuation. Okay, so part B is on the stock valuation. So on the stock valuation, we have the beta here. It says the stock in the road pay of Zambia has a beta of 0.85. The market risk premium is 8%. And the Bank of Zambia Treasury bills, Bank of Zambia Treasury bills currently yielding 5%. Treasury bills are risk-free securities. Okay. Treasury bills are risk-free securities. So, and what is going on here is that they are simply saying that the most recent dividend was 1.6 per share, and the dividend expected to grow at 6% per annum. Okay, rate indefinitely. If the stock sells for 37 per share, what is your best estimate of the company's cost of equity using both the Gordon's model and the capital pricing model? 15 marks. So let us start with the capital asset pricing model. Capital asset pricing model. Our cost of equity for this is equal to risk-free plus beta return of the market minus risk-free. So this one here, RM minus RF, is called market risk premium. Market risk premium. So this one is called market what? Risk premium. This is a stock beta. So our cost of equity is equal to, I may seem maybe to be too fast. People are quiet. Are we following? Are people following?
Yes.
Okay. So from here, our beta is 0.85. Okay, so B is 0.85. And of course, the other thing that we know here is on the aspect of the risk premium is 8%. So risk premium is the difference between this one, 8%, and the beta for this one, okay, the risk-free rate is 5%. The risk-free rate is RF is equal to 5%. So this one is going to give 0.05 plus beta of 0.85. On the risk premium, they have told us to say the risk premium in the question was 8%, which is 0.08. So our KE is equal to 0.85 by 0.08 and plus 0.05. So it's giving us a 0.118 or 11.8%. 11.8%. So this is it on the aspect of cost of equity using the capital asset pricing model. Now, using the Gordon's model, the dividend discount model, excuse me. So the Gordon model is actually cost of equity is equal to GO, okay, 1 plus G over PO plus G. This is provided that dividend is paid. Provided that dividend is paid. So DO is a dividend paid. This one is dividend paid. PO is a stock price. Then G is a growth rate. So substituting here, we are getting our KE is equal to the dividend that has been paid most recent 1.60. So it's 1.60 using this formula, please, from the Gordon model. Okay, growth rate is there, 1.60 on 1 plus the growth rate. The growth rate in the question was given, which is what? Growing at 6% from here. So the growth rate is 6%, 0.06 over the stock price. Stock price is what? Our stock price is 37. 37, then plus the growth rate of 0.06. Our cost of equity is actually 1.6 on 1.06 over 37, then plus the 0.06. Are people following? Okay, are people following so far?
Yes, we are following.
So the answer is what? 0.1058, or it is 10.58%. So this is our cost of what? Cost of equity. So you please take note of this question. So this is provided that the dividend has been paid. There's also another Gordon model when the dividend hasn't yet been paid, when they have just declared. So the formula is KE is equal to D1 over PO n plus G. So this is it on the aspect of that dividend is expected in the question, and they expect dividend to be paid. Expect dividend to be what? To be paid, because the D1 is a dividend, but which is declared, not paid. It's just been declared, not yet paid. Not yet paid. So this is what goes on here. All right. So PO is a stock price. Okay, I'm sure we are getting this one. Then G is a growth rate. Okay, so this one is our growth rate. So this is what goes on here, please. So we have we've looked at this question. So make sure you have time to go through these examples of how questions come. So we can end the class for now, unless there are some questions so far.